To add a market voice to the conversation now, Ed Yardeni is president of Yardeni Research. A couple of things to talk about, Ed. I was talking about you earlier. Glad that we have you on. Number one, let's just address what we were just talking about, and that is whether the Fed has the tools and the foresight to be able to control inflation if it's already sort of baked in. And we go back, you remember, you were around. I mean, when it gets bad, it's hard to handle if you let it get out of control. That's what we saw. Could that happen again? Or is
yeah, I mean, Joe, the Fed officials have been talking about what they believe is the fact that they have tools for dealing with inflation, and they just keep using this term tools. Well, what are they actually talking about? The only tool I know of is to tighten credit policy, to raise interest rates, to stop buying bonds. So if, in fact, they come around to the conclusion that there's more of an inflation problem and more persistent problem than they anticipated, they'd have to raise interest rates, and then they take the risk of causing a recession. I mean, that's what Volcker did to bring inflation down. That's really the only precedent we have for a tool environment to bring inflation down, is raise interest rates.
The other issue that just occurred to me is that I'm trying to figure out whether inflationary expectations can become reality before they actually should be. Because right now we've got bottlenecks. We know chips, reopening, it all makes sense why we're seeing, trying to get people to come back to work, so you got to raise their wages. So it very well could be transitory. But we also have a very activist administration that controls both houses, essentially. Right. So the $4.1 trillion is probably not just someone's fantasy. It could come close to happening. And I can't imagine how that isn't something that a monetarist would say, that's going to, down the road, that is going to cause inflation. Can it already be happening based on the prospect of that happening?
Well, I think clearly there's a prospect for even more fiscal stimulus coming out of Congress. But meanwhile, if you look at M2 is $5 trillion higher now than it was right before the pandemic. M2 is basically equivalent to a year's worth of nominal GDP, which is an all-time record high. A lot of people look at the velocity variable. They look at nominal GDP divided by M2. I like to look at it the other way and point out that we've got a year's worth of nominal GDP in M2 today. And that means that there's a tremendous amount of stimulus still left over, if you will, that's kind of been parked or, in liquid assets that could continue to fuel very strong nominal economic growth. And since we are basically having real GDP at an all-time record high during the quarter just ended, that could certainly produce more inflationary pressures. Look, the Fed keeps talking about bottlenecks and about base effect, but there are lots of variables that suggest that the longer that they hold off on raising interest rates, first tapering, then raising interest rates, the more that they risk putting inflation into the system on a more permanent basis.
Shepard Smith here. Thanks for watching CNBC on YouTube.